this week it will, so you can work on your other things instead of that. So, all right, let's get into.
Professor, I had a question.
Yes.
Is test 3 due on 5/9? That's the Saturday after our class next week, and that seemed really short compared to the last tests.
Yeah, you're probably right. I don't think I've moved that date back. So why don't we move that to the following Thursday, so you have a full week. That sounds about right, doesn't it?
Yes, that sounds like what we've been doing.
Yeah. Okay. We'll go with that schedule.
Okay. Thanks.
I'll fix that. All right. So we're talking about changes of stockholders' equity, going back and kind of picking up the stuff that we went through quickly when we talked about the statement of changes in stockholders' equity way back at the beginning of the semester. So treasury stock is probably the most common change to stockholders' equity, or something to do with treasury stock, that you'll find if you were to look at company financial statements. So you've got both a purchase. Now, treasury stock is a review from, you probably should have talked about this in Accounting 200, but treasury stock, when you buy it, you debit treasury stock and you credit cash. That's your journal entry for the cost. Most companies do so using the cost method to account for their treasury stock. And then when you sell it, you're going to debit cash and credit treasury stock. Now be careful, you don't try to credit common stock. You credit treasury stock when you sell the shares you originally repurchase. So I know that seems a little confusing because you originally sold shares when you started the company or over the time. Then when you buy it back and make it treasury stock, you're going to put it in the treasury, debit the treasury stock, and then if you resell that treasury stock, you're going to credit treasury stock. Now, when you sell it, when you resell that treasury stock, you may sell it for a different amount than what you originally paid for it. You should always credit treasury stock for the amount you originally paid for those shares. And then you debit cash for the amount you sold it for. Now, if those two numbers aren't the same, the difference goes to additional paid-in capital. So while it sounds like if you sold it for more than you paid for it, you have a gain. And we talked about, you know, we've dealt with gains when we sell assets, but treasury stock is not an asset. Treasury stock is a contra equity account, and FASB prohibits us from having any impact on the income statement from transactions in treasury stock. So no gain, no loss goes on the income statement. We have to have a place for it other than the income statement, and that place is additional paid-in capital, at least for most companies. So that is how treasury stock works. It also changes the shares outstanding, because the number of shares outstanding for a company, which is important when we talk about earnings per share, goes down when we buy treasury stock and goes up when we sell treasury stock, when we sell it again, or resell it, if you will. All right, we'll do an example of how that affects our calculation of earnings per share a little bit later. Okay, so that's that's a first change that we need to be able to account for is treasury stock, purchase and sale. Looks like Lindsay arrived. So just a second. There we go. Lindsay is in. All right, next one, stock splits. Really, stock splits and stock dividends kind of go together, if you will, because they both kind of have the same impact, or you might say even little impact. Stock splits, there's going to be no journal entry for a stock split. Now, just so you make sure we are on the same page, a stock split simply means that I want you to think of a stock split as if you own a share of stock, and let's say represented as a piece of paper. I mean, in the old days, that's what it was. It was actually a certificate saying you own shares. If that represented your share of stock, and I would do a stock split, I would take that piece of paper from you, cut it in half, and give it back to you. You would have exactly the same stock as you had, you just have twice as many shares. So if you had 50 shares, I would take them, cut them in half, and give them back to you. You'd have exactly the same amount of paper, but it would be in smaller pieces now. All right, so no journal entry, but the number of shares that are outstanding would be doubled if it were a 2-for-1. You can just cut it in 3 pieces and give it back to them, a 3-for-1 stock split. But that's the nature of that scenario. All we do is represent that as the number of shares that are put on the balance sheet. Stock dividends are similar. However, stock dividends do bring with them a journal entry. Typically, we're going to debit retained earnings and credit common stock additional paid-in capital. Typically just common stock. So stock dividends, well, the question is then how much? Stock dividends can either be at par value, or they can be based on the fair market value. Now, I will tell you in real life, no one does it on the fair value because no one does what's called a small stock dividend. So we're going to just pretend that large stock dividends are the only one. And a stock dividend is you're giving a percentage. So instead of cutting the shares in half, if I have 100 and I give you a 30% stock dividend, you have 100 shares, I'm giving you 30 additional shares. So I would take 30 times the par value, figure out what that dollar amount was, and I would debit retained earnings and credit common stock for that stock dividend. That's how you calculate. So you would see a decrease in retained earnings and an increase in common stock.
So you only credit common stock or additional paid-in capital, not both?
Usually if it's a large stock dividend, it's just common stock, but you will sometimes see companies that combine common stock and additional paid-in capital in one line, because there's nothing that says you have to break those two out, okay? And so in that case, it would just be the one. And I have seen them use additional paid-in capital, but usually it's common stock.
Okay, thanks.
Okay. All right. Now, share-based compensation is the idea that I pay my employees not with money, but with stock in some form. And there's multiple forms you can take. You can pay them in what's called stock options. You can pay them in restricted stock, which gives them stock, but it has a whole bunch of restrictions on it. So it's not like a person outside the company would own the stock. and it's all for employees. Now, here's the basic idea of share-based compensation, whatever form that takes. At the point that we make the agreement to give those shares or those options to the employee, we determine their value, their fair value. And so that would be given to you in any problem, anytime in real life. I mean, because the dollar amount of the fair value of a stock option or the fair value of restricted stock is a mathematical formula that's well beyond what we want to cover in this class. So either one of those would be given to you, that value. So once I know that my option is worth $4 per option, let's say, and I'm giving to my employees 1,000 of them, then I have compensation of $4,000 that I need to record. The problem is, or I don't know, the problem is the accounting issue is that is not compensation right now. That's going to be earned, because here's the deal. I'm going to say to my employee, the only way you can actually use these options or this restricted stock is if you stay employed with us for the next 5 years. And so what I need to account for is that $4,000 of compensation over the next 5 years. So I'm going to take 4,000 divided by 5, get $800 a year, and I'm going to record $800 each year until I reach year 5, where I'll have recorded all 4,000. As long as nobody leaves the company early, then that's how I will account for it all the way through. If someone leaves early, I have to adjust that. But otherwise, I record that each year. Now, what does that have to do with stockholders' equity? Well, when I record that, I'm going to debit compensation expense, and I'm going to credit additional paid-in capital, which is a stockholders' equity account, and you're going to see that increase to the change as one of your changes to stockholders' equity. So as these employees earn it, so not at the beginning, not when they first are given the options or the restricted stock, but over time as they earn it, it'll be recorded and increase our stockholders' equity and our compensation expense. So debit and expense, credit, equity. The last one is a lot more rare. I guess you could say share-based compensation is very common. Treasury stock, the most common. Stock splits, stock dividends, kind of in between. Conversion of bonds is pretty more on the rare side, and that is simply a situation where I have loaned a corporation money as a bond. I've loaned them money in the form of bonds, and we'll talk a little bit more about how that might look. And instead of having them pay me back in cash, they're going to pay me back in stock. However, it'll be my choice which I want. So at the time that let's say they borrow it for 10 years. At the end of 10 years, I will say to them, I want you to pay me in cash, or I want you to pay me in stock. And I'm going to pick whichever one is the most, right? I'm going to pick the biggest of those two. So I get to choose what the conversion, whether I get the stock or cash at the end. That's why if I choose stock, that's going to affect my stockholders' equity. That's going to increase my stockholders' equity. This equity is going to go up, and the liability for the bonds is going to go down by the same amount. So if I loan them $10,000, then when they convert it to a stock, okay, their journal entry is going to be a debit to the bond payable, that liability, and a credit to common stock or additional paid-in capital for $10,000. Same amount. All right. So while we're brought out bonds, some definitions, just because bonds are a little more unusual in terms of the types of liabilities. Think of bonds as a way of borrowing from lots of different people instead of from one bank. And that has the advantage of you can spread out your the liability to lots of different people. Lots of different people can loan it money to you, and therefore in theory you can get more of a bigger loan that way. It also comes with some headaches because instead of paying one payment to one bank, you're going to be paying lots of payments to lots of people. Typically there's going to be somebody that takes care of that for you. You're going to make one payment to a trustee who's going to turn around and divvy up all of those payments to all the different people who loaned you money. If you just think of the idea of a GoFundMe, if you've seen that idea where lots of people can give you different money, but think about trying to pay that back. That's what a bond kind of would look if GoFundMe obviously is not that idea where you're going to pay them back typically. But if you were going, by having it out there so that everybody can join in, you get, in theory, more money coming in to borrow. You borrow more money, but you also have the headache of trying to keep track of all those people and pay them interest and their money back. So that's a good illustration of what, the advantages and disadvantages of a bond in terms of borrowing. Okay, so some definitions: serial versus term bonds. Serial bond, you pay off how much you owe a little bit at a time. Term bonds, you pay only interest and you don't pay back any of the principal until the end. So a serial bond's more like a mortgage or a car loan that you're used to. A term bond is kind of unusual for us personally, because the chances of us getting a term bond at a bank is almost nil. We don't go in there and say, okay, I want to borrow $50,000 for this car and I want to pay you just interest for the next 5 years, and then at the end of 5 years I'm going to pay you back the total, how much I borrowed. That's not how we can borrow, but that is how companies do borrow with these bonds often. Secured versus unsecured. If you think about the difference in your life between a credit card, which is unsecured, and your car loan, what happens if you don't pay your car loan? They repossess your car. That's a secured loan. That means there is collateral that they can come and get if you don't pay. An unsecured, or your credit card, there is nothing for them to come and repossess. If you do not pay your credit card, they do not come and get your stuff that you bought with that credit card. In fact, there's no way to know which of your stuff is stuff that you bought on the credit card or not. So they can't do that. So they have to trust you a little bit more, you might say, because they don't have anything to repossess. So secured loans are usually lower risk and lower interest rate than unsecured. And the same thing happens with bonds. If a company borrows money and promises, if they don't pay it, to give you collateral, give you assets, give you a building, give you equipment, then it's secured. If they have no promise, they just promise to pay you, they don't have anything to give you, it's unsecured. And most of bonds are unsecured because, let's be real honest, if you had to repossess equipment from Ford Motor Company in their factory because they were defaulted, what would you do with that? I mean, how would you go about going and collecting that equipment and selling it and all that kind of stuff? Think about what a pain that would be. So most bonds are unsecured. Convertible, we talked about the idea of converting our bonds into stock. That has to be part of the original agreement to the bonds. You can't just decide that. It has to be part of the original deal. And then the term callable means that the company who borrowed the money can pay it off early. If a bond is callable, it can be paid off early. If it isn't callable, you can't. You cannot pay it off early. You cannot buy it early. You can always persuade people to sell it to you, but you cannot, if it's callable, you can force them to pay it, sell it to you and buy it back. Typically, if it's callable, you pay some extra penalty. In the old days, many years ago, most loans had what's called a prepayment penalty. So if you borrowed to buy a car and decided you wanted to, had some extra money and wanted to pay it off early to save your interest, you may be charged a penalty because the bank's now going to have to go find somebody else to loan that money to. That has really gone away with bank competition. Too many people trying to loan you money to buy a car, or a house, so that sort of thing. So there are no prepayment penalties in today's world for us as consumers. However, there still exists on the business loan side quite often, actually, and this is an example of that. You would pay a call premium, which is the same as a prepayment penalty. It's really an amount extra you're going to pay on top of paying it off. So if you were to look up, this is more of a understanding the world around us. If you were to look up what we call bond quotes, see, Ford Motor Company has borrowed lots of money. They have, to do that, they have sold bonds. And you see here that they have done so multiple times. So think about each one of these is a loan that Ford Motor Company has gotten from a whole bunch of people. Now, in doing so, they have agreed, Ford has agreed to pay what's in this column, interest only. This is the coupon rate. This is what determines how much they're going to pay every 6 months, typically. This here is what's called the maturity date. This is when they're going to pay up until that date. So like, for instance, in this one, they're going to pay 7.125% until 2025. And really, it's half of this every 6 months until we get to 11/15/2025. Now, what this is the rate of interest that those who own the bonds are expecting from their investment. So these people who loaned Ford money are expecting or wanting from their investment 4.5% approximately. So how is it that Ford is paying 7 and we're expecting 4.5? Or the investors are? Well, that is reflected over here in the value of these bonds. These bonds, or the amount that would be borrowed, would be 115% of their face value. So for instance, if this were originally face value 1,000, we would actually be loaning Ford $1,157.10. Okay. By loaning them more than $1,000, when they pay us 7% based on 1,000, they pay us that we're really only making 4.5%. That's how bonds adjust based on changes in interest rate. What becomes apparent is that when Ford originally borrowed this money, interest rates were higher than they are right now. And therefore, the value of the bonds, and remember, we're talking about present value, just like we talked about 2 or 3 weeks ago, in terms of the present value of the future payments, those present value are higher than what that was originally agreed to and borrowed. So that's how bonds get sold and bought. Laura.
The 4.8%, so that changes, like when interest rates go up or go down, I'm sorry, and bond yields go up, does that mean that the 4.48% is going to go up then too, right?
Most likely, yes.
Okay.
Okay.
So it has potential to be higher than the 7.125.
It can go either way, yes.
Okay.
But it goes in the opposite direction of this price or the value over here. So if this were to go up towards 7%, these would go down towards even 100.
Mm-hmm.
And then if this were 7.125 and this were 7.125, this would be exactly 100, the value. And then if this one went above 7.125, then these would actually go below 100. Okay.
Okay.
So that's how they are related. And yes, those are changing based on people buying and selling these bonds. Because by having Ford borrow from lots of different people, they probably borrowed $100 million, but each person only loaned them, let's say, $1,000. That means that that person can sell their little piece to someone else, and then Ford will owe them instead of me. And so every day people are buying and selling these pieces, if you will, of Ford debt. Okay, and if I sell it to you, then you get the payments from Ford, and I stop getting the payments from Ford. So that's basically what this slide is talking you is the pieces from that last one. Okay, when we initially record a bond, when it's first sold, we record either a discount or premium depending on whether we sell it, and we always sell bonds at their present value of the future cash flows, and we learned how to do that. Whatever value that is compared to the face value, the difference is either a discount or premium. Okay, so when we'll look at an example of that bond and how that would play out when we get to our Excel spreadsheet. So over time, whatever you record as a discount or premium has to be gotten rid of, and it's called amortization. Remember, the term amortization is just used a couple different places in accounting. We amortize intangible assets, which is just like depreciation. We pay off loans, and it's referred to as how much each payment is an amortization schedule. Bonds are also amortized, and what that means is we are paying or reducing down the discount or premium, okay, over time. And we can do it either using the straight line method or the effective interest method. Now, most of the time, the straight line is close enough to the effective interest. Even this, the effective interest rate is required by GAAP, but the straight line is usually close enough that you don't have to do the extra work that the effective interest rate method does, because the difference between the two is immaterial. All right, a little bit about some ratios before we go look at some examples. These first ones should be familiar. Current ratio and quick ratio. Calculate the current ratio as current assets divided by current liabilities. The quick ratio as quick assets divided by current liabilities. And when we refer to quick assets, we're talking about cash, any kind of marketable securities or short-term investments, and accounts receivable of various types. It does not usually include inventory or prepaids or other. Typically, most companies have what's on the balance sheet, something that's other current assets. It's not going to include that. In both cases, you divide the amount of the assets, either the current assets or the quick assets, divided by the current liabilities. So same number on the bottom, different number on the top. You're measuring how liquid, how easily the company can meet their obligations by turning their assets into cash and then being able to pay their bills. If you have a current ratio of 2.5, you're more liquid than a company that has a current ratio of 1.5, meaning you have more cushion to be able to pay your liabilities and have some extra. So that's what is being looked at with the current and quick ratio. They should move roughly in the same direction, meaning if you're comparing 2 years together, if the current ratio went up, so probably is the quick ratio. But they should never be the same, and the quick ratio should always be lower than the current ratio, because you should always have a lower amount of quick assets than you do current assets. Okay, so that's what the first set of ratios. The next one, looking at your debt load, how much debt you're in compared to your situation. So debt ratio compares your total liabilities to your total assets. Total liabilities divided by total assets. Total assets usually is converted into a percentage, but not always. Debt to equity is comparing your total liabilities to your total equity. So very similar, but looking at a different reference point. The more debt you have compared to your assets, the more debt you have compared to your more equity to your equity, the more what we call leveraged you are, the more risky your business is, the more risk you have of going bankrupt. However, you also have a greater opportunity to do very well because you're using other people's money. And as long as you can earn enough with their money to pay the interest especially, then you are going to be able to generate more and better returns than if you didn't use debt. Now there's a couple of other ratios referred to as the coverage ratios, which take your income off the income statement. So the debt ratio and debt to equity are all balance sheet. Coverage ratio compares your profit, your income, to how much you have to pay in interest or how much you have to pay in lease payments, depending on what coverage ratio you're talking about. If you're talking about an interest coverage ratio, then it's what you pay in interest. If it is all payments, interest, principal, lease payments, then it would be, you would include all of them. So you need to be specific when you're looking at a coverage ratio, what you're including in that. And you're taking your income and you're dividing it by whatever your payments are to see how many times you cover it. So think about yourself. If your income from your job is $2,000 and you have a $500 payment on your car, you have a 4 coverage ratio. You have 4 times as much income as you have for car payment. And you could then say, well, okay, then let's just look at the interest in that car payment and take your $2,000 of income and divide by just the interest. Or you could look at it as a full payment, or you could then include your car payment and your house payment and decide that you have a different coverage ratio. So it compares income that the company is making with how much it has to pay in for debt payments. All right, turnover ratios. We have 2 that we probably look at the most, and that's inventory turnover and accounts receivable turnover. You're comparing, for inventory, comparing cost of goods sold with your average your average inventory. And accounts receivable turnover, you're comparing sales with average accounts receivable. And when you're getting average, you're usually taking beginning plus ending, divide by 2. Okay. Now all of those, you could look up the formula. For the most part, you'll get the right thing if you Google it or whatever. But you're measuring how many times with the turnover, how many times your inventory is sold per year, or how many times per year you're collecting your accounts receivable. So you're looking to have that be somewhat high. You want it to be selling your inventory multiple times per year. You want to be collecting your accounts receivable quickly, but they can also be too high, meaning you are not selling enough because you're being so stingy on your credit with your customers, and your accounts receivable turnover may be very high, but you can't get very many sales because you're being so stingy. Your inventory turnover is too high. That means your inventory could be too low, and you're actually having to say to customers, I don't have that. I don't have that. And that can result in long-term a problem with your customers. So both of those can be too high as well. It's not just an unlimited be as high as you want, and higher is always better. To a point that higher is better, but they can be too high. Now profitability ones, notice the turnover is not a percentage. Inventory accounts receivable turnover should not be expressed as a percentage. The number of times per year it turns over. Profitability, these are usually percentages. So we take our income, and you may recall our discussion about taxes and such, and so a lot of times we ignore taxes when we do that. So we get our income before taxes, so because we know all the crazy stuff that goes into calculating tax expense, especially now, and we say, well, that doesn't really have much bearing on how successful we are. So we're going to take income before taxes. We're going to either divide it by assets to get return on assets or return on investment, or we're going to divide it by sales to get our profit margin, or we're going to divide it by our total stockholders' equity to get our return on equity. In each case, the top number of your ratio is the same. The bottom number changes depending on what you're looking at. You want to see how well you're doing with regard to your assets, then you use the first one. If you want to look at how you're doing compared to your sales, you use the second one. If you want to look at equity, the third one. But make sure you're comparing, when you compare two companies or one company to itself, that you're using the same measure all the way through. Okay. Now, this last one, cash flow ratio, all those ratios should have been presented to you in other accounting classes. Cash flow ratios are typically not. Our cash flow statement, the most important number is cash flow from operations. That's the number that was referenced most often. If a company can't generate cash flow from operations, they got trouble. And so to see if they're doing a good job of that, we typically look at the cash flow from operations, and that's literally how much cash is coming in because of their day-to-day sales and activities. And compare that to current liabilities to say, are we generating enough cash to pay off our debts? That's current liabilities. Are we being efficient at generating cash compared to our assets? We take our cash flow from operation, divide by total assets. Or we could look at it in terms of all the loans we have, not just the current liabilities, but total debt. Okay, any one of those may be an effective way to see how we're doing, especially with generating cash. All right, so each one of those could be used, and that's a less common. If you were to look up ratios, that those cash flow ratios have become more popular, but they're still not well used in a lot of places. All right. Questions? Looks like there was a question and answer in the chat that I missed, but I'm glad that got an answer. All right, let's take a look at this set of financial statements for a minute to give you an example of real life and how this might play out. So this is FedEx Corporation most recent balance sheet. Okay, so they do a fiscal year May 31st, 2019. So the balance sheet is a little bit old, but we haven't gotten to May 31st, 2020. So this is the most recent. So that's the year they use, May to May. So as of the last May, we're looking at the stockholder investment, they call it stockholder equity section of the balance sheet. We list common stock or preferred stock first, and the preferred stock always gets their dividend first. So it should be listed first if there is any. Most companies don't have it. For whatever reason, some companies will put preferred stock even though it's zero on their balance sheet. FedEx does not list it as zero. But if there had been any, it would have been first. It would have been right above common stock. Then we list common stock, and then we give this information about the common stock. Okay? So we have par value, which was established when this company was first organized many years ago. And it's 10 cents a share. Now that's only important for a couple of things, and that is when we sell new shares and when we do a stock dividend. So for FedEx, if they did a stock dividend, they would look at, let's say they gave a 50% stock dividend. They would look at how many shares they have issued right here, because it says they had 800 million shares authorized, 318 million shares issued. I would take 50% of that, which would be 159, and I would multiply it by 10 cents to figure out the amount that I would make my journal entry for that stock dividend. And then that amount would be a increase to this and a decrease to retained earnings.
Can you say that again?
Sure. So if I were to do a stock dividend for FedEx, if I were FedEx, I would announce a 50% stock dividend. At this point in time where I have 318 million shares issued, I would calculate that 50% of that is half, right? 159. That would be 159 million shares. So everybody who has 10 gets 5 more. And so I would send out 159 million shares of new stock. To record that, I would take the 159, I would multiply it, 159 million, all those zeros, I would multiply it by 10 cents or 0.1, figure out what that amount was. I would debit retained earnings and credit common stock for that amount. So I would see an increase in common stock and a decrease in retained earnings. Okay. So that's what par value is, why it's important. Other than that, we don't pay that much attention to it. This is they can never sell more than 800 million shares. That's what they agreed to when they started the business way back when. And you can see that they haven't really even gotten close to that. They've only so far issued or sold 318 million shares. So they would have to sell a lot more shares before they would get close to the 800 million that they agreed that they wouldn't go over. Now, if you'll notice something, if you take the 318 times 10 cents, that would be 31.8, and you round it, that's 32. That should be the dollar amount over here on the balance sheet. So this is all share information. The dollar amount is over here in the nice column in your balance sheet. So the dollar amount should equal the number of shares issued times the par value. Okay. We know additional paid in capital is retained earnings. We remember way back learning about accumulated other comprehensive income or loss, AOCI. And here's where we put treasury stock. At the bottom of the equity section, usually the last item on the balance sheet, especially if there is no non-controlling interest. That's what I was trying to think of. Okay. So, and notice that it is in parentheses because it is a debit balance. The normal balance is a debit. It is subtracted. So over the years, FedEx has bought back $9.289 billion. That's what they spent on buying back their own share of stock. So every year, again, that carries over, and when they buy more, it goes up, and if they sell any, it goes down. Now, I would say that FedEx is not giving us all that we would like, because I would like to know how many shares they currently own in their treasury. And they did not tell us. We know the dollar amount they paid for them, but we don't know the number. And often that should be in like a parentheses, kind of like this tells us numbers. This should probably say numbers as well. So in my opinion, they haven't given us all the information that they should have. It's probably in a footnote somewhere. We'd have to dig it out. But that should be something, I think, that should be on the face of it. Now let's look at this statement of changes in stockholders' equity, which explains how we got where we went. Okay, so remember we saw that their treasury stock at the end of May 31st, 2019 was 92.89. It was 79.78 the year before. Those two numbers were on the balance sheet. What changed? Well, during 2019, or during that fiscal year, they bought treasury stock of $1,480,000. They spent that much money. And here they told us that they bought 6.6 million shares. So at least they were good to tell us how many they bought during the year. So they paid this much money and they bought this many shares. So that made our treasury stock, if you will, go up or more negative, however you want to think about it. So it was already a negative. It was more negative because we bought more of the shares. But we also gave away some of those or sold some of those shares. That's what this positive number is. So when our employees who had stock options or incentive plans are actually given their shares. So we'll see a little bit more about how a stock option plan works in a little bit. They can then buy shares at a set price. When they buy those shares, they have to come from somewhere. And FedEx has chosen to take them out of this treasury. If you imagine this, in the old days, way back in the old days, it was a treasury. It was big box. That's where all these, we bought the shares from the investors and we put them in the box. Well, that's where the term treasury stock came from. Now there's no box, it's all electronic, but it's the same idea. We buy them from the regular shareholders, and in this case, we have a big pile of them, and then when the employees get rewarded, we take them out of that pile, because we could either take it out of that pile or we could print up some new ones, brand new ones. If they were brand new ones, we would see them come out of, we would increase common stock. Instead, they are a credit to treasury stock. And you can see that we sold them to the employees for more than what we originally paid for the treasury stock, because we increased additional paid-in capital. Additional paid-in capital went up by the amount we sold it to the employees for more than when we paid. Remember, we always credit treasury stock for what we originally paid for it. We see dividends, we see net income. That's the two changes we focused on way back when we did these statements before. So we've already talked about the comprehensive loss. So really we're focused on this treasury stock transaction, purchase, and sale. Okay. Questions about this real life financial statement from FedEx.
Why does the employee incentive go in all three places? The APIC, the retained earnings, and the treasury stock?
Because there's more than one just thing happening here. You notice it says incentive plans and other. And so I just want you to focus on the idea that if it was selling shares to the employees, it is the treasury stock and additional paid-in capital. Okay, and because we're not sure what some of the other is. Companies have a tendency to lump a little too much into other, as in my opinion, but that's what they've done. But we can see here that there were employees received 1.3 million shares as part of this incentive. Now that could have been spread amongst 1.3 million employees and only got one share each. Doesn't, you know, we can't tell that. We just know that it was in total. Okay. So yes, once in a while you'll get that muddied up by something that's other, but the general idea is if you sell it for more than you paid for the treasury stock, then you're going to make additional paid-in capital go up. If you sell it for less than you bought it for in treasury stock, then it would go down. All right. How do we apply all this, Laura said? Which we mean all of this? Which one?
Just all of these principles to like the exercise or the homework, which I guess you're going to do. You're going to bring up Excel, right? And then you're going to show us how to.
We're going to do it. We're going to do an example.
Okay.
That would try to illustrate multiple of some of these. Okay. So let's see. All right. So you should see an Excel spreadsheet, and this is already posted in the materials. Okay. So this is mostly to show us how we deal with earnings per share and calculating earnings per share. So we introduced that idea way back when we talked about the income statement the first time, but we knew that this was the formula: net income minus preferred dividends equals divided by weighted average shares outstanding. But we gave you the weighted average shares outstanding. Now we're going to look back, okay, and see how that plays out, how we would calculate weighted average shares outstanding. So here's our example. We have a company, they have 250,000 shares outstanding. And outstanding shares are those shares issued minus the shares in the treasury. So any treasury shares are subtracted from the shares issued to get our outstanding. If you haven't bought any treasury stock, then your shares issued and shares outstanding are the same. They only change or are different if you bought treasury stock. So Harmony begins the year with 250,000 shares outstanding. On the first of the year, Harmony awards 40,000 stock options to employees as compensation. The options have fair value of $2 each and will be earned over a 4-year period with an exercise price of $15. So what we're giving to the employees is a right to buy stock at $15, no matter what the price is. If the, you know, whatever anybody else is paying doesn't matter. What matters is that these employees can buy it for $15. Now, of course, that's a good deal if the price for everybody else is over 15. It's a bad deal if the price for everybody is under 15. So no employee would actually utilize this. Okay, it's kind of like a coupon to buy something, but the sale price is already lower than what your coupon price is. So why would you use the coupon? You're not going to insist on paying more, right? So think of an option as a coupon. It's a coupon to buy something at a set price, not a cents off coupon, but a coupon that says I can buy this item for this exact price. Now, remember we talked about compensation. So when this is agreed to on January 1, we have 40,000 shares, 40,000 options. And each one of them, we always are going to look at this at fair value at $2. Notice that we're not using the exercise price. We're using the fair value. That means the compensation that we're dealing with is $80,000. That's going to be earned over 4 years. That means 20,000, whoops, per year. So while we did this whole deal on January 1 with the employees, and we established the $2, we established the $15 at January 1. We would not make a journal entry on January 1. We would wait till the end of the year when the employees will have earned $20,000 by that point. And at that point, we would debit compensation expense. Whoops, you got the idea. And credit additional paid-in capital. And you would do that $20,000 each year for the next 4 years. So the year that they first got them, they would earn the 1 year. If you gave it to them halfway through the year, then the first year they would only earn half of that $20,000. Just like any other, we could break it down by, you know, how much time of the year they had those or earned for that year. So that's one issue, and that would affect additional paid-in capital, right? That would be a change in our stockholders' equity. All right. So on May 1st, we repurchased 10,000 shares for $15 in cash using the cost method. All right. And we're going to assume the cost method for every situation unless told specifically otherwise. So on May 1st, we're going to, in the journal entry, pretty easy, treasury stock, okay, 150,000, and credit cash, 150,000, right? And that's just 10,000 times $15. The exact cost, which is why it's called the cost method. And that changed our stockholders' equity, right? In the treasury stock column. If we assume that there was no treasury stock prior to this, this would be our first change to the treasury stock part of this statement of changes in stockholders' equity. Okay, so now we've got this changed to additional paid-in capital and this changed to treasury stock in this first year. Now, December 1st, we resell some of the treasury stock. we're going to sell 1,000 shares of treasury stock for a total of $20,000. So we're going to debit cash $20,000. All right, we're going to credit treasury stock for how much? Well, what did we pay for it? We paid $15, and it was 1,000 shares. So we're going to credit treasury stock for $15,000. Where's my other credit to make it balance, right? I got debit of 20,000, credit of 15, additional paid in capital, 5,000. Again, another change to our stockholders' equity, shown on the statement of changes in stockholders' equity. Okay. So we have already answered, well, the average share price is $22. What is the price that the employees can exercise for? $15. That's some point. We'll return to that idea in just a minute. Okay. We know what the net income is, so we can calculate our our earnings per share. And we have no preferred stock, so no preferred dividends, making our EPS a little bit simpler. Okay. And what was the change in equity due to the stock options? Well, we've already done that. We've already calculated that it would be $20,000 for the first year. Okay.
To get the $15,000 that you paid for those treasury stocks, did you just figure that the 1,000 they sold was of the 10,000 they purchased on May 1st?
Yes.
Okay.
Because we made the assumption that this is the only treasury stock they have. If you have multiple times that you bought treasury stock, and in real life you might have that, but I don't think we're going to have anything that we'll take on anything that complicated. We like our assumptions, and so GAAP actually says we assume FIFO, first in, first out, from our old inventory days. And if you'll remember, we liked FIFO, we did not like LIFO, so that's the good news. But yes, if you have multiple purchases of treasury stock, and that's the case in real life, companies are buying treasury stock all the time. So yes, FIFO would be an important assumption. Okay. So we know that our net income is $1 million given to us. Nice round number. Okay. We know there's no preferred dividends. So the top number, okay, in our calculation of EPS is $1 million. And now we have to calculate our weighted average shares outstanding. So we go now up here and we know that there are 250,000 shares outstanding when we started. And that was the case for January, February, March, and April when it changed. So from January through April, there were 250,000 shares outstanding. That's 4 months out of the 12 months of the year. So we multiply 250,000 times 4/12 to get a weighted average. In May, or May 1st, beginning of May, we bought stock, shares, which makes the number of shares go down. So instead of having 250, we now have 240. And that will be the same for May, June, July, August, September, October, November. 7 months out of the 12 months of the year. So we take 240 times 7/12 to get 140,000. Then what was the last change? We resold 1,000 of them. So our shares go back up. The number of shares outstanding goes from 240 up to 241. And that's for just 1 month, December. So we multiply 241 times 1/12 equals 20,083. We add those up, and that gives us our weighted average shares outstanding. So you're looking at the changes in shares outstanding, the amount of time of the year that it exists. You're multiplying and then adding up. We take the $1 million net income, we divide by the 243,417, and we get basic earnings per share, which in this case is $4.11. And our earnings per share should always be a dollar amount and cents. Should always be rounded to the nearest penny, and it should have a dollar sign by it. So we remember that this is literally, this company earned $4.11 for every share of stock outstanding. So if a shareholder owned one share, this company made them $4.11 on their behalf. Okay. So that is always our first step, is to do the basic earnings per share the way that I just showed you by doing the weighted average. If they happen to have the number of shares outstanding the same all through the year, then you don't have to worry about this nonsense. You just take the number of shares outstanding and divide it, and you're good. When you go to next year, when you have to do the next year to calculate weighted average shares outstanding for year 2, you do not start with this number, you start with this number, because that's where you ended up with shares outstanding. This is an average. This is what actually is outstanding on December 31st at the end of year 1. So when you start January 1st of year 2, this is the number of shares outstanding. So instead of having 250 like we started here, we'd start with 241. Okay, now moving on to the concept of fully diluted. I explain in the materials that I provided for you that diluted shares outstanding has to do with pretend shares, anything that might become common stock. So there's 3 things that can be turned into common stock. Bonds can be converted into common stock, preferred stock can be converted into common stock, or in this case, the one we're going to look at, options could be converted into common stock. Employees who hold these options could show up and say, I want shares. And I have to give you some money, but I want the shares. And therefore, that would mean we have to divvy up the net income amongst more shares. And that's what fully diluted is about. It's about figuring out what's the worst case scenario if everybody showed up and wanted to turn in their coupons or whatever for shares. How many shares would we actually have to give out? Okay. So fully diluted, here's all the things that could happen: preferred stock, convertible bonds, options, restricted stock, and conversion of bonds, and so forth. That is not the order you should look at. You should always look at options first, and it's the only one of those 3 things that we have in our problem. So we're going to look at the impact of the options. We have, for this first year, 40,000 options we gave to our employees. Okay? We know that because they haven't earned them all yet, there's only 10,000, or 1/4, right? 40,000 divided by 4, only 10,000 really count. The rest haven't been earned yet. So we know that the employees can't show up and use that other 30,000. They can only use the 10 they've earned. So we're only going to consider the 10,000 possibility.
And how did we get the 10,000 number?
Because we knew that they had earned Remember our share over here, they've earned it over 4 years and 1 year has gone by. So they had 40,000 options. And so they've earned 1 year out of 4, that's 1/4, or 10,000 options.
Okay.
Okay. So next year, if we were doing 2 years, it would be 20,000, right? Would be what we'd have to worry about. And the next year, 30,000. Okay. So we're going to just do the 10. Now, we start pretending now. We pretend that those 10,000 options, the employees brought in their coupons and they said, I want to buy stock. And this coupon says I can buy it if I pay $15 a share. All right. So they do. They bring in their 10,000 coupons. They all pay $15 each, and they give the company $150,000 in cash. Remember, this is pretend. There's not a journal entry at this point. We're just pretending that they gave us $150,000. That would make the number of shares that we have outstanding go up by that same 10,000. Okay? But we'll come back to that. We're going to then further pretend that we took the 150,000 we collected from the employees and we bought other shares like treasury stock. We bought other shares from other shareholders. Okay? We took that $150,000 and we bought those shares. How many shares could we buy if we used all 150,000 to buy shares? Well, we can buy exactly 150,000 divided by 22. Where did the 22 come from? Average share price. Okay, $22. So we take the cash collected divided by 22, the average share price, and that gives us 6,818. So we gave to the employees 10,000 shares. We turned around and bought 6,818. So how many really new shares do we have? 10,000 minus the 6,818, 3,182. That was the impact of your stock options. So to calculate fully diluted earnings per share, we take the $1 million, same as we did up here. We divide it by this WASO 243, 417 we calculated up here, plus the 3,182 impact of the stock options. And we get $4.06, always lower than basic. Fully diluted is always lower than basic. If it's higher than basic, then you either made a mistake or, okay, you would actually ignore that calculation and just use the basic earnings per share because it's not a dilution, what's called a dilution. Now, with options, you will always have to worry about this if the exercise price is below the average share price. So if employee sees this deal, I can buy the shares for $15 and the share price is $22, then that's a bargain. If this average share price was $13 during the year, that would be a bad deal. No employee would exercise their options, and therefore we would not have any of this happen. We would not assume or pretend that they did come in and turn in their money and get their shares, because we know I mean, we're pretending, yes, but we don't want to pretend what's something that's crazy or that's never going to happen. And so we are only pretending because it's likely to happen. And that is because the exercise price, they get to pay 15 and the share price is 22. If that were 13 average share price, then we don't need to pretend because we know they're not going to turn in their shares. They're not going to turn in their options. Okay. And here's that journal entry for the compensation expense, a little more clearly laid out. Okay.
Can I ask a question? How did
Sure.
you get 3182 impact of stock options? I missed that.
Okay. 10,000 minus the 6818.
Okay.
Okay. So the 10,000 that new shares that we pretended to give to the employees minus the shares we pretended to buy from other stockholders with the money that the employees gave us.
Okay, thanks.
I know it's a lot of pretending. Pretend you're in the land of make-believe, okay? Basic is what actually happened. Fully diluted is pretend. That's how I like to think about it, to remember. And what you basically have said is this is the worst possible. And why is this lower? Because I have to share the net income with more people. So the example I use in the explanation in the materials I provided, I always like to use the example of pizza. More people show up to your party, you got to divide up the pieces into smaller pieces. Everybody gets less pizza. Given that the amount of pizza, the number of pizzas you have is fixed, more people show up, less pizza for each one. More shareholders show up, less net income for everyone.
So why does GAAP want to see that fully diluted if it's just a potential situation?
Because for that very reason, remember the idea, the concept of conservatism we want to look as bad. We never want to be surprised on the bad side. So we want to consider all possibilities of, you might say, the bad things happening. And lowering earnings per share is a bad thing. And so we're going to look at the impact of anything that might lower our earnings per share. So that's what this is. It's an idea of kind of considering the worst possible scenario.
And we do this every time there's a scenario like this?
Yes, as long as if there's any company that has options or convertible preferred stock or convertible bonds, they would do this each year. Now, you're only worried about this usually at the end of the year. It's not like you're making a bunch of journal entries during the year. This is kind of a one time a year kind of scenario. Although if you're a publicly traded company, you have to do earnings per share every quarter. So you got to do it 4 times a year. But this is it's one of those things that doesn't happen that often. But a lot of things go into figuring it out. All right. Other questions?
On the homework and actually on the practice too, they both have unrealized gains and losses. That goes back to many lessons ago, right? With the
yes. So that's going to impact your AOCI, right?
Right. Okay. And we already did those journal entries, if I remember right, way back when.
Yep. So nothing's changed on that.
You just threw that in there for fun.
Just to see if you're, still have those notes somewhere.
Somewhere.
because all these things kind of tie together, and that's part of the challenge sometimes in accounting, is keeping them all where they intersect with each other. And so that's important, because one of the things I find when I deal with folks that are new to the actual practice of accounting in real life is they know individual topics and they can think it through, but they have a harder time kind of saying, oh, that's how that relates to that, and see where to go back. Even if you have to look something up in real life, that's okay. It's when you don't know or don't remember or don't think through what you should look up. It's not that you have to look things up. That's to be expected by professionals even. It's the idea that you don't remember, don't see that this actually is something you need to look up and where you might relate it to. That's what the point that you saw that and saw that it needed to go back to something we learned earlier is exactly what I want you to, pick up out of that. So you see how that's related to what we're learning now. Other questions?
The forfeited, where did it say that? The options that have been forfeited, did we talk about that?
Let me give you an example of how that might play out. All right, let's take this example we had here, where first year we recorded $20,000 of compensation expense. Actually, let's go down and use this journal entry down here. So this would be year one, usually at the end of the year one. And we would expect that year two would be the same, right? Except what happens if some of these options are forfeited? That means people leave. So let's say that, let's just use 10% forfeited. So now, instead of 80,000 total, it would be 80,000 times 0.9, right? Or 90%. If 10% is forfeited, 90% is still there. So 72,000. Okay? So we now know that this whole plan is not going quite the same as planned, and we can't just go on doing 20,000 a year. So we have to look at year two and we say, okay, now we're talking about 72,000, and we're halfway through the plan. And that's because I have 2 years now out of 4. And that means that I should have half of the compensation expense recorded. And my total compensation expense is 72,000. So half would be 36,000. I have go ahead.
So the forfeited amount decreases the amount of options that are still available.
Exactly.
But because you're halfway through the 4-year process, you're also dividing it by 2.
Right.
Okay.
Okay. The point being that we should, at the end of year 2, we should have recorded a total of $36,000 of compensation expense. We have already recorded $20,000 last year. So we will record 16,000 in year 2. Okay, your journal entry looked the same as the debit compensation expense and credit additional paid in capital, but you do and make an adjustment for the forfeited amount. But you don't go back and fix year 1, right? Because it's not an error. It's just a difference in our estimate. We estimated when we started that everybody would stick around. Our estimate was wrong. But we don't go back and change year 1's compensation expense. We simply make a journal entry that kind of, you might say, catches up or adjusts to what it should be now. Kind of the way we do depreciation. If we have a change in the useful life or something, we don't go back and fix past years. We just use the new information to calculate the new expense. And that's what we did here. Other questions? All right. So your homework, as alluded to by a couple of questions from Laura, who's already looked at it, is to basically take 2 years or start with 1 year of stockholders' equity, make the journal entries or changes for the year, and then have your ending balance and create a statement of changes in stockholders' equity that looks like what we did, what I showed you from FedEx, at least roughly. Okay, so you'll have the example, practice. I'll describe how you should have done it, or at least how I would have done it. And again, we're not worried about exactness in terms of, what the column, which column order or some of the other things. We're looking at basically the idea of how you would lay it out and such. So don't get too caught up in the exact methodology as much as the things that are the big picture of how you would make the changes and get to the ending balances. And then, of course, as usual, the homework, how I would do it is also there for you to look at and make any comments or changes to what you did. All right. Everybody else good? We lost, it looks like, Jessica somewhere along the line, but I didn't notice when she left. And there's always, as always, the questions, the place to put your, just because there isn't a discussion this week doesn't mean you can't post questions on the other discussion board, the non-graded one. So please use that still. And then, yes, next week we will do the test review example. And it will be very similar to the very first exam we took, the last one, in that we will do 1 year as a review, and then you'll do the next year as the test. All right. So good luck. Have a great weekend, and I'll see you next week then. Take care.